Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. The firm only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability.
Welcome to Navigating Retirement with Rick Durkee.
And welcome into another edition of Navigating Retirement with Charleston and the Low Country's resource for a common sense approach to planning for your financial and retirement future. He is president and founder of the Coastal Financial Planning Group. Rick Durkee once again with us. Rick, welcome back in. Preparing for the Retirement Planning Summit number 6, the annual event, aren't you?
Number 6. And you know, we advertise it, Charleston's Retirement Planning Summit number 6. But you know what I've learned here in this recent situation here where we have to do a lot of things online, webinars and Zoom meetings and things like that. And our podcast, Peter, is that we're spreading. People are learning about us and passing our podcasts on and the Retirement Planning Summit information and whatnot. We're USA wide. I mean, we are picking up some clients from referrals from our current clients here in Charleston across the country. So our information is valuable. Please take these podcasts and share them with other people that you feel that will benefit from this information. Take advantage of our Retirement Planning Summit. And to coin a phrase, and this will not be a political phrase, but I still am an American patriot and I believe in our country. Let's make America great again. Let's share this information. Let's go into retirement with some of the best opportunities that we'll ever have as a generation of boomers. And let's help one another out. Let's help mankind out. No matter what type of, race, color, or creed, we want to help our fellow brother Americans out. So share this information. And today I'll look forward to talking about these 4 approaches to addressing long-term care and medical expenses in retirement. Yep. Big topic.
Absolutely. Well, if you would like any of these reports, by the way, in the series of the Countdown to Retirement, which is the Are You Prepared? The 12 questions to know if you are ready for retirement, the 5 planning mistakes to avoid, the one that we will cover today, the 4 approaches to addressing long-term care, the 3 biggest expenses in retirement, the 2 questions to answer, and the 1 factor determining retirement. Those are the Countdown to Retirement series of reports. If you'd like those, if you'd like to get them in your hands, physically or digitally, so you can go over them on your own time with your spouse, your friends, your neighbors, your loved ones, your family. Pick up the phone, give a call, just request the Countdown to Retirement from the Coastal Financial Planning Group, 800-491-6220. That's 800-491-6220. So Rick, this issue of planning for and addressing long-term care and potential medical expenses in retirement, this has really been a problematic issue and topic in the world of financial and retirement planning, not just for us as individuals, but for the financial industry. They've gone through some changes and evolutions in how to address this big issue that's plaguing retirement.
Yeah, it is a big issue. People got to this point maybe 15 years ago and they saw long-term care insurance come out and they thought, oh my God, I got insurance on my cars. I got it on me if I can't work. I got it on me if I die. Well, I'm insurance poor. I don't need to protect against any other risks. And this long-term care looks like it could be expensive and I may not even use it in my lifetime. And then I lose all the dollars that I put into it. This is not the way we should look at long-term care. What we should look at it from the standpoint of is financial mistakes that are made by not planning on it. It's not about having long-term care insurance. It's about having a plan where assets can step in and be leveraged so that they can be used in the most effective manner to be able to provide you the income that you need to pay the bills for long-term care. Traditional long-term care insurance is one option. There's many other options that we can use. And I will just say this personally, it's been one of my personal I'm an advocate for long-term care. When a client or potential client comes into the Coastal Financial Planning Group and tells me that they have a long-term care plan, I say, you are my client. I want to work with you because you're planning for your future properly. You already talked about it. You already did it. It's great to have this in place, but it may need to be reviewed also because this cost is going up regularly as far as the care for long-term care. So let's talk about this one today, Peter. It's number, the 4 approaches to addressing long-term care need to be discussed today.
Absolutely. A big issue, a big topic, the potential expenses associated with long-term care. They are not covered by Medicare. They do have some protection with, I think, Medicaid, Rick, but that's kind of a very last line of defense. And there's a lot of stipulations and requirements for you to essentially be broke before that one kicks in. So what are the approaches to long-term care? How can we address it? Ladies and gentlemen, to go through the options, request this report, the 4 approaches to addressing long-term care. It's simple. It's 1 page. It just lays out what your various different options are. So it's good food for thought for you. And then it helps you decide what approach maybe you should consider pursuing. Give a call, 800-491-6220, 800-491-6220. But Rick, number 1 is that traditional long-term care insurance plan, which was problematic because it's use it or lose it. And largely, I think now the insurance industry doesn't even offer this as a product any longer. That tells me that it was problematic and not profitable for them, which means that it's probably an even bigger issue for us as individuals than we would like to think.
Yeah, it wasn't priced properly, and it was not factored in as to the people that took it out. They factored in that a certain amount or percentage of the people that took out private long-term care insurance would let it go and not continue to pay those premiums, or that they would die. And so the insurance industry found themselves stuck in a situation where it was underpriced. Inflation had increased in long-term care costs, and they were on the hook to pay for their book of business that, they, thank goodness, had the opportunity to be able to increase premiums so they could still pay those benefits out to those people that paid premiums for the policies. And, they didn't go out of business because, the thing is, we depend on insurance companies to provide us with the guarantees that they promise us. And so, there are actually a few companies that still write traditional long-term care insurance. However, it's best to take traditional long-term care insurance out as one of your 4 options when you're younger. I personally took out mine at age 45. I tried to apply for another policy at age 47. I was not able to qualify due to a medical issue, and that medical issue has long cleared up since then. My wife was able to get that second policy because we had a standalone policy, and then we had a medical reimbursement policy that we just got reimbursed and didn't have to provide receipts for. It was a cash policy, it was called, that they offered back then at my age 45. I'm 61 now. But the point that you make is very poignant. If insurance companies don't offer it anymore, it means that the risk was too much and they couldn't insure it of you needing it. So need to take heed of that. If we can't or don't want to look at traditional long-term care insurance to protect it, let's have one of these other 3 options provide us some care.
Well, again, we need to understand and explore all of the options and decide which one is best for us. That's why this report of the 4 approaches to long-term care is helpful, food for thought to explain the options, and then you can go in detail in that review session with the team from the Coastal Financial Planning Group and Rick Durkee. Give a call if you'd like the report or if you'd like to have this discussion. It is a serious and very important issue and certainly deserves some time and attention. 800-491-6220. That's 800-491-6220. Rick, I know we're going to have to barely skim the surface and fly through these, but let's get into the alternative options to addressing this long-term care. I know that the insurance industry didn't just stop offering this. They sort of evolved how they were handling addressing long-term care. And now, more often than not, it's not a use it or lose it type of proposition. There are benefits that one way or another, we're going to be able to use and utilize with linked benefit solutions.
Mhm. These linked benefit solutions that you talk about were alternatives to the traditional long-term care where you could maybe not use it in your lifetime. Now these policies are actually attached to different insurance products, either life insurance or annuity contracts, where they enhance the benefits of those particular products. I'll go through them very quickly. Life insurance offers a long-term care rider where you can access your death benefit of your life insurance that is leveraged. So you might have a $100,000 life insurance benefit, but if you don't die in your sleep and you need it for long-term care, it may pay for up to $200,000 of long-term care. These policies also offer liquidity provisions, so you could get your money back if you decided you didn't need to use it. That's the life insurance end. Many traditional life insurance policies all now offer long-term care riders that you don't have the option to get the money back, but you can receive leverage benefits during your lifetime, income tax-free for long-term care planning. So look at your old life insurance. Maybe it might be time to update that life insurance to get some long-term care additional use out of your life insurance. The second opportunity is annuity contracts. Annuity contracts pay guaranteed lifetime income, and oftentimes with long-term care riders on those annuities will pay enhanced income. For example, they may double the income payout percentage if you need stay in a nursing home, assisted living, or care in your home. So these are opportunities. There are number two option for approaches to addressing long-term care and expenses that are medically related in retirement. And so let's move on to our third.
Well, number three on the list, Rick, I am certain that you run into some individuals who are of this status where they've got the assets, they've got the financial means to be self-insured, to cover those potential costs of care, whatever they might be into the future. They've had the blessing, the success, the luck or the hard work and built up the asset level that they could cover those costs. My issue with this approach, when I am insuring something, my house or my car, I don't utilize the full value of the asset to provide the insurance. If I've got a $30,000 car, I don't insure it with $30,000. I use a fraction of the value to provide the full insurance value for the vehicle. When you say you're self-insured, you're essentially using the entirety of your portfolio to provide the insurance when you could probably essentially do it with a fraction of that cost, Rick.
Mm-hmm. That principle in financial planning is called leveraging, Peter. You use pennies to provide dollars in benefits for yourself in the future. So when we look at self-insuring, where is that money going to come from? And is that proper income allocation for using our assets so that they, provide the best benefit for us, for our spouses, and for our potential legacy benefactors when we're no longer here? So you have to analyze that plan. You have to look at it in a retirement income allocation plan and determine when we plan on having these care needs. Are we using we'll call them smart assets, okay? We all got smartphones now. Let's use the smart assets to pay for long-term care if we are going to self-insure. And that may be the equity in your home. You may want to use a reverse mortgage or something like that as a safety net. It's all okay as long as we have the plan in place. So that's why we always
plan is. Yep.
Yep. That's why we always encourage you, to pick up the phone and reach out to us and get that plan in place, that retirement income allocation plan, so that you have all your bases covered for these risks that we're talking about today.
Well, the fourth option, probably least attractive of all of these, Rick, but if we do not plan, if we do not take the time to address this, it is the de facto default plan, which is to rely on family and ultimately to become potentially a government dependent. The government plan is, I don't think, anyone's ideal plan for how to address this, and relying on family, placing that burden on them, also not anyone's ideal solution to this. So really, we need to consider some of these other options and alternatives.
Yeah. And Peter, I have people always tell me, I do not want to become a dependent of my children. I do not want to burden them,
Yep.
with this potential care. And I'll
probably, Rick, in their peak earning years, therefore hindering their own financial progress.
Right. And how they can protect themselves for this potential expense in retirement for long-term care. So we don't want to be a burden. We want to make sure we have a plan in place. I'm sure that people probably didn't see this commercial, but I really want to walk back in time a little bit. It was about 15 years ago. And I think it was America's Council on Aging or whatever, but it had an aging parent sitting in the back seat of the car, and it had the two children, the husband and the wife, in the front seat. It wasn't their children. It was a son and a sister, or a daughter-in-law.
Yep.
Daughter-in-law. Okay. And they're sitting in the front seat, and nobody's lips are moving, but they're thinking, and you can hear what they're thinking. And the lady in the back seat is saying, I never expected I would be this burden on my children. I would never expected that I would be in this position where I had to depend on my children. And the children are thinking up front, we never expected that we were going to have one of us quit our job so we could care for mom at home. We never expected that she would have to live with us at this point in time. We never expected all of these things. Why didn't we expect those things? We didn't have a plan in place to protect ourselves for this. So planning is the key, folks. This is how you can avoid these potential long-term care and medical expenses in retirement. We hope that you've learned something from this today. We hope that you take action on it today.
Yep.
Action is the key to power and having control over your future life when it comes to planning for long-term care and the expenses involved with that. So please pick up the phone and give us a call today. Let's learn some more about this together.
Absolutely. Well, food for thought. This report is good conversation starter with your family, your parents, your children, your spouse, your friends, your family, your loved ones. Pick up the phone, give a call, get this report, The 4 Approaches to Long-Term Care, as well as the comprehensive compiled Countdown to Retirement series of reports, the 5 planning mistakes to avoid, the 3 biggest expenses and how to plan to control them, and so on. The Countdown to Retirement really covers a great deal of issues in your financial life and addresses many of the risks and helps you identify some opportunities in your planning. Pick up the phone, give a call, request the Countdown to Retirement, 800-491-6220. Rick and his team also extend the offer and opportunity to sit down and go through the planning process with you individually. No cost, no obligation. There truly is no downside for placing this call. There is never any benefit from procrastinating. There's no need to meet in person to get answers to your questions and address your planning needs. Give a call now, 800-491-6220. That's 800-491-6220, 800-491-6220. Rick, we always appreciate your time. Thank you for being here and sharing this important information on our Countdown to Retirement mini-series here on Navigating Retirement.
Make sure that you tune in for our next episode of the 3 biggest retirement expenses here on our 5-part series.
Always a great conversation with Rick Durkee. Give a call, 800-491-6220. Visit online, cfpgroup.biz, cfpgroup.biz, info@cfpgroup.biz. Email that if you'd like more information on the Retirement Planning Summit coming up. We'll talk to you soon. Take care.
Catch more of Rick Durkee and Navigating Retirement by visiting cfpgroup.biz.
While we believe the information in this broadcast is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decisions. Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.